Hi friends, so in the last class we have seen the direct taxes and indirect taxes and we have seen GST in detail. So in this video we are going to cover banking system and in particular we are going to cover RBI in detail. So in the recent times you would have seen in the news that there is a tug of war between RBI and Government of India. So we need to know RBI in detail. First, it is established on April 1935 with the provisions of RBI Act 1934. So RBI came into existence in 1935. RBI is headquartered at Mumbai. Okay. See, before 1949, RBI was a privately owned bank. But after 1949, after the nationalization of banks, RBI is fully owned by Government of India. See, the affairs, the day-to-day activities of RBI are governed by Central Board of Directors. So, what is it? See, whatever RBI is performing its activities, be it a monetary policy or any other day-to-day activities, the affairs of the RBI are controlled by Board of Directors, Central Board of Directors. So there are totally 21 members in the Board of Directors. See, it is necessary to know the composition of RBI Central Board of Directors. The reason is that you could use it in your mains answer writing and it will be helpful to you for understanding the current affairs. Okay. So, RBI Central Board of Directors is composed of 21 members. Okay. So, who are they? Governor, we know. 4 deputy governors. Okay. Governor, there will be 4 deputy governors and 4 directors from the local board. Okay. So, RBI though headquartered at Mumbai, it has 4 directors, local directors, okay, 4 directors from local board, then 10 directors nominated by central government. So, the central government also nominates 10 directors to the Central Board of Directors of RBI. Then, 2 officials of the central government, okay. See, the tenure of the RBI governor is 5 years and he is eligible for re-election. See, the tenure is not exactly 5 years, but at most it can be 5 years, which means maximum it can be 5 years. Okay. Then 4 deputy governors, their tenure is again, it's at most 5 years. It is not exactly 5 years. What does it mean? It means it can be 2 years or it can be 3 years, but it can never be more than 5 years, right? Then he is also eligible for re-election, okay? See, 4 directors from the local board, they have a tenure of 4 years, okay? They have a tenure of 4 years and they are eligible for re-election, right? Now, the 10 directors nominated by the central government, their tenure is also 4 years and they are also eligible for re-election. And these 2 officials of the central government, see, they are under the pleasure of the government. They don't have any specific tenure, right? And they also can be re-elected. And the main point what you have to notice is they don't have any voting rights. Okay. See, I told you the composition. RBI consists of board of directors and the board of directors are having these peoples, right? Who decides this? See, it is decided by RBI Act of 1934. Okay. It is under the section 8 of RBI Act of 1934. So remember this section 8 of RBI Act because it will be helpful in writing mains answer. Okay. Now, I discussed about section 8, okay. See, in recent times in the newspaper, you could see that section 8 and section 7 are often repeating in the articles, right? So, what is this section 7? I told you section 8. See, section 7 of RBI Act 1934 says that government can issue directions to RBI in public interest after due consultation with the governor of RBI. So, what happens actually? If there is no section 7, RBI has some kind of autonomy. Autonomy in the sense I am talking about independency, right? So, it is independent body, some kind of independency it has, okay? But what if section 7 is there? See, if a government issues section 7, government can issue directions to RBI in the public interest after due consultation with the governor. In such a cases, the board is controlled by central board, okay? In such a cases, the RBI day-to-day activities are controlled by central board, okay? Generally, how does the RBI functions? See, the RBI, though it has the central board of directors, the major decisions, and in the monetary policy committee, you don't have the 10 directors and the officials nominated by the central government, right? But if section 7 is there, the governor of RBI alone cannot take any decisions, okay? Which means all these 21 people will together influence the decisions of RBI. So, why is it necessary to look at section 7 in detail? Because look at here, see, I told you these two officials are not having any voting right. Okay, so if you look at here, this deputy governor and the directors from the local board. Apart from this, there are 10 other directors nominated by the central government. In case any decision has to be taken under the section 7, see, in case any decision has to be taken under section 7, who will win the battle? It's obviously the central government because it has 10 directors nominated by them, right? So, the majority wins. So, you have to look at the section 7 carefully, right? Now, see, RBI is a 100% government of India owned body. You have to remember this at any point of time, okay? What happens? How does the RBI earns money? Basically, we need to know that. See, RBI earns money using seigniorage. What does that seigniorage mean? See, it is the printing of currencies. Okay. The next is by giving loans, then by investing in securities. So, the investment can be in India or the outside India. Okay. So, how does RBI earns money means? These are the three ways which the RBI will earn money. So, by seigniorage, by loans and by investing in securities, right? See, what happens if with this amount, if RBI earns profit by all these three ways? See, some portion of it would be kept as an reserve for contingency. Contingency in the sense emergency, okay? Some portion of it would be reserved for emergency and the remaining portion would be given to central government, right? So, I told you about section 8 and section 7 and how does RBI earns money? By seigniorage, by investing in the securities, right? And then by giving out loans. So, what does the RBI does with the profit? RBI keeps some money for the contingency and it gives the remaining to the central government, right? So, see, I have given an overview about the structure of RBI, right? Now, we have to look into the functions of RBI. See, the first thing which will come into your mind is monetary policy of RBI, right? See, there are two policies which you have to keep it in your mind. One is a monetary policy and the other one is fiscal policy. So, what is a monetary policy? That's what we are seeing. What is a fiscal policy? I think we have seen in the last videos which deals with public finance, right? So, which means fiscal policy is basically formed by the central government, whereas monetary policy is formed by RBI, right? See, monetary policy refers to the policy of central bank in matters of interest rates, money supply and availability of credit. So, in short, if I wanted to tell what is monetary policy, it is the policy of central bank. Okay. So, what is this monetary policy going to do? See, it is through this monetary policy, RBI controls the inflation in the country. So, I told you what is inflation in the last videos as well. So, what is it? It is consistent price rise of the products, right? So, if there is a price rise over a period of time, then we say that there is an inflation. So, this inflation is controlled by RBI's monetary policy. Okay. So, see, why should RBI do this? The power to conduct monetary policy is explicitly mentioned under RBI Act of 1934. So, there may be a question in prelims, where does the RBI derive the power to frame the monetary policy? So, RBI derives the power to frame the monetary policy from the RBI Act of 1934. See, what is the main goal of monetary policy of India? The main goal is to maintain the price stability. Okay. See, the main goal is to maintain the price stability because this is the necessary precondition for sustainable growth. Okay. This is a necessary precondition. Why? If there is a price stability, only then the investors will invest, right? So, only if the investment happens, the country can grow, right? So, this is a necessary precondition for a country to grow. Now, for this, inflation needs to be controlled. If there needs a price stability, then it means that inflation needs to be controlled. Okay? So, we told that inflation needs to be controlled, and who's going to do that? It is the RBI. See, there is a term called flexible inflation targeting framework. What is it? It is a flexible inflation targeting framework. What is this term? I am repeating it. Flexible inflation targeting framework. What is this? See, it is through this the RBI Act provides Government of India in consultation with RBI once in every 5 years. What is this? See, basically, when you wanted to set an inflation target, okay, we call it as what? We call that as flexible inflation targeting framework. So, we are targeting inflation. So, who sets this inflation target? It is the RBI Act, okay. It is the RBI Act which says that Government of India should set the inflation target, but in consultation with RBI once in 5 years, right? So, the inflation target is set once in 5 years by the central government, but in consultation with RBI, right? Now, the central government has notified plus or minus 4% of CPI inflation. You have to understand the word CPI. CPI means Consumer Price Index. Okay. So, it says plus or minus 4%. What is this plus or minus 4%? It means it can go till 6% or it can come till 2%. Okay. We call this as what? Plus or minus 4% of CPI, Consumer Price Index. So, what is this Consumer Price Index? We'll discuss in detail when we are dealing with inflation. But for now, understand that these are the figures of the goods which the normal consumers consume in day-to-day life. That's what you have to remember for CPI. So, I told you RBI and the Government of India together has set up an inflation target of plus or minus 4%, which means upper tolerance level is 6% and the lower tolerance limit is 2%. I told you this is for period of 5 years. So, it is from 2016 to 2021 this target has been set. Okay. So, after 2021, the central government may discuss with the RBI governor and come up with a new inflation target. Okay. Now, okay, the government has said this. Sometimes there would be failure in inflation targeting. So, when will you say that the inflation targeting has failed? See, when the average inflation for more than 3 consecutive quarters is greater than upper tolerance level. What does it mean? It means, say for example, we have 12 months, right? So, in 12 months, if I wanted to separate it into 4 quarters, so 3 months, 3 months and 3 months, 3 months, right? See, for 3 consecutive quarters, if the inflation level is greater than the upper bound, which means it is greater than 6%, then we say that the inflation targeting has failed. Or the second situation is for consecutive 3 quarters, the inflation level is less than 2%. Then also we say that it is failure of inflation targeting, right? Now, coming to monetary policy framework. So, what we saw that who is setting the inflation targeting, right? Who sets this? Now, monetary policy framework. So, what is this monetary policy framework? See, RBI operates the monetary policy framework of the country. Remember, RBI operates the monetary policy framework. See, since RBI is operating it, who decides it? Framework in the sense what? They are forming a certain rules and regulations, the pattern, all those things. It is decided by Monetary Policy Committee. Okay. See, this Monetary Policy Committee is a 6-member committee, right? Which is constituted by central government under RBI Act of 1934. So, Monetary Policy Committee is a 6-member committee. Okay. See, these committee must meet at least 4 times a year. Which means what? It should meet every quarter, right? I told you there are totally 6 members. This also has a quorum. Quorum means what? It is a minimum attendance for the proceedings to take place, right? So, quorum of Monetary Policy Committee is 4 members and each member has 1 vote. In the event of equality of votes, the governor of RBI will have a second or casting oath. Say for example, 6 members are there, okay, and in the 6 members, one is absent, remaining 5 members. So one in this 5, one is RBI governor. So 2 members, okay, they vote for and they vote against. So in this case, RBI will have casting oath or second oath, okay. See, the resolution adopted by the Monetary Policy Committee is published after conclusion of every meeting of Monetary Policy Committee. What does it say? It means that after every meeting is over, in every quarter, the conclusion is published. Okay? See, published by RBI. There is a report, Monetary Policy Report. Okay? Monetary Policy Report is published by RBI. So, what does this report contains? The report explains the source of inflation. What does the report explains? Source of inflation and the forecast of inflation for next 6 to 18 months. Okay. So, after the Monetary Policy Committee meets every 3 months, that is every quarters, it has to publish its result in the form of Monetary Policy Report. So, what is the Monetary Policy Report contains? It contains a source of the inflation and the forecast of the inflation for next 6 to 18 months. Forecast in the sense what? It is predicting what will be the inflation in future, right? Till now we have seen what is a monetary policy, what is inflation targeting, where does RBI gets all those powers from. Now we have to look into monetary policy instruments. It is this which you daily read it in the newspapers as repo rate, reverse repo rate, bank rate, all those things. So we are going to see it now. See, what is the first one? It is the repo rate. So what are we seeing now? We are seeing monetary policy instruments. In the sense, these are the instruments which RBI uses to frame its monetary policy. Or you can say that these are the instruments which the RBI uses to control inflation. Okay? Repo rate. Interest rate at which RBI provides to banks. Listen carefully. RBI is providing to banks against the collateral of the government. So, RBI will provide an interest rate, okay, for a loan amount against the collateral of the government. But you have to notice here that it is for a short-term period. So, repo rate is a short-term instrument. There may be questions in your paper which are all these short-term instruments. So, you have to pick repo rate. Repo rate is a short-term instrument of RBI. So, it is the interest rate at which RBI provides to banks against the collateral of the government. Now, reverse repo rate. What is this reverse repo rate? See, it is the rate at which RBI provides to the bank for depositing the money with them. Say for example, see, I'll explain you with the help of figures. Say for example, here is RBI, okay? Here is RBI and here is bank. So, if bank goes to RBI asking for a loan, okay? Bank is going for RBI and asking for a loan. In that case, RBI will charge an interest rate, okay? That is called as what? Repo rate, okay? Now, what is reverse repo rate? See, RBI again, bank. Now, what the RBI is saying, you park your money with me, I will give you an interest rate for that deposit. Okay. Now, RBI charges an interest rate. For what? For deposit. Okay. We call this as what? We call this as reverse repo. Here, the interest rate is paid by the bank to RBI. Okay. But here, the interest rate is paid by RBI to the banks. Okay. So, always the repo rate would be greater than reverse repo. Okay. Remember, this repo rate is a rate in which the RBI gives money to the bank and in turn, bank have to pay the interest rate. In the case of RBI pays the interest rate to banks. Okay. There is also something called MSF. Apart from this repo, we have seen repo rate and reverse repo rate. The next instrument, that is the third instrument, is MSF, Marginal Standing Facility. This is another monetary policy instrument created by RBI in 2011. See, it is the rate at which the banks are able to borrow money from RBI against the government approved securities. Okay, against the government approved securities. Okay, see, what is the difference between repo rate and the marginal standing facility? I told you repo rate is also a rate at which the banks can borrow money from RBI, right? But what is the difference? See, this marginal standing facility is applicable only for scheduled commercial banks. Okay? From RBI, the scheduled commercial banks can borrow money when they have exhausted all other options but at a higher rate than the repo rate. Okay? So, always remember, reverse repo will be less than the repo rate. Okay? But marginal standing facility will be greater than the repo rate and it is applicable only for the scheduled commercial banks. So, what is a scheduled commercial bank? See, if any bank is listed under Schedule 2 of RBI, then we call it as a scheduled commercial bank. So, this MSF, Marginal Standing Facility, is applicable only to the scheduled commercial bank. See, you have to understand this. MSF will be higher than repo rate and repo will be higher than reverse repo. So, MSF, that is marginal standing facility, is greater than the repo rate and repo rate is greater than the reverse repo. And I told you MSF is a tool which is applicable only for scheduled commercial banks. Okay. Now coming to bank rate. So what is this bank rate? See, it is the rate at which the RBI is ready to buy or discount the bills of exchange. See, if I have to tell it in simple terms, it is the same as repo, but it is for a longer period of time. See, bank rate means it is a rate at which the bank can borrow money from RBI in a simple term. But what is actually happening? We call that as rediscount of bills of exchange. So see, let me explain you bank rate with the help of a diagram. Let us say an example, if a person is going to deposit a money in the bank. Okay. For simplified example, let us take it as 100 rupees. Okay. At the same time, a borrower is coming to the bank and asking for a loan, right? So what will the bank do? See, the bank will get the money from the depositor and gives the bank to borrower. Okay. Say for example, some time period 3 years, right? And he is saying that the interest rate is 20%. So 20% out of 100 is 20 rupees, right? Now, what happens? Suddenly, the depositor again comes to the bank and asks for the deposit. Okay? See, what will the bank do? The bank have given the money to the borrower. Now, the bank goes to the RBI with the bill, right? With the bill in the sense what? With the document asking for 100 rupees. Okay? But what is the use for the RBI to give the 100 rupees back to bank? See, what will the RBI do? Bank has given 20% interest rate, which means 20 rupees, right? Now the RBI will say, see, you are in need of money, right? You are in emergency. So, I will give you money, but I will give only 18% or it may be 17%. Okay? Which means what? Less than the interest rate which the bank has given to the borrower. For borrower, bank has given to 20%. Now, when the bank goes to RBI, what will the RBI do? RBI will reduce the interest rate. Why? Because it needs some profit, right? What is the profit it will give by giving the money to the bank? It is this 3% or 2% profit which the RBI gets. This is called as rediscounting the bills of exchange, which you will see it in many books, right? So this is the bank rate. Now, next is the CRR. What is CRR? It is cash reserve ratio. What is it? It is the money which the bank have to keep in RBI. Okay? The bank is required to maintain the money in RBI. We call this as what? We call this as CRR. Okay? Now, SLR. What is this SLR? It is statutory liquidity ratio, is the money which the bank have to keep with itself as a reserves. Okay? But then you will see a term called NDTL. What is this NDTL? See, it is net demand and term liability. Okay? It is a net demand and term liability. So, if I am going to redefine both CRR and SLR, how can you say? It is a bank which it has to keep certain share of net demand and time liability. Net demand and time liability with RBI is called as CRR. This is a perfect definition which you can use it for your mains answer writing. So, the bank has to keep some share of net demand and time liabilities in RBI. We call that as CRR. Okay. Now, SLR. See, it is the certain share of net demand and time liabilities which the bank has to keep it with itself, right? This is called as SLR. Now, you may get a doubt, what is this net demand and time liability? See, net demand and time liability. Let me explain you net demand and time liability with a picture. See, this is a bank, okay? A person is coming and depositing money in the bank, right? See, this would be considered as liability. Okay? Always remember, the deposits or liability to the banks, right? Now, a person is coming and asking for money, that is for loan in the bank, okay? That is called as an asset. See, always loans are called as what? Called as assets. Why? Because the person has to repay the money to the bank, right? At some interest rate, right? Now, what kind of demand liability? I told you it is net demand and time liability. What are the two kinds of demand liability? It is savings account and current account. Okay? It is the savings account and the current account. Okay? Why is it demand? See, both in the savings account and in the current account, whenever you are going and swiping the card in the ATM machine, the bank has to give back, right? Whenever you are demanding, the bank has to give the money back to you. So, this comes under demand liability, okay? Now, what are the time liabilities? See, time liabilities are fixed deposits and recurrent deposits, okay? Why is it time liability? For a fixed period of amount, you will not demand that money, right? That is based on time, right? So, we call that as time liability, okay? So, what is this net demand and time liability? See, in a simple language for our understanding, because we no need to go into the depth, we wanted to answer the questions which is appearing in the preliminary, right? For that point of view, let us simplify the net demand and the time liability. So, how can we do that? We can say that as total deposits, okay? Total deposits minus the total withdrawal, okay? Total deposits minus the total withdrawal. We call that as net demand and time liability. So, now you would have understood what is the term net demand and time liability. There was also a question in PT. What does the term net demand and term liability is associated with? Which means it is associated with banking system. And now I told you that what is demand liability and what is the time liability as well, right? Now, the next instrument in the monetary policy is open market operations. See, what will happen in the open market operations? It is the direct purchase of and sale of the government securities by RBI for injection and the absorption of liquidity. What does it mean? It means that whenever there is a more liquidity in the market, RBI will absorb the money, okay? Whenever there is a less liquidity in the market, RBI will inject the money. How is it going to do? Say for example, what is meant by liquidity first? See, liquidity is nothing but the total amount of money, okay? The cash circulation it is talking about. So now, say for example, in an economy, there is more money in circulation than it is necessary, okay? Now, what will the RBI do? RBI will come and sell the government securities, okay? At a higher interest rate, at an attractive interest rate, okay? So, what will happen? At that time, RBI sells the government securities so that public can buy the security by which some money will be taken away from the economy, right? The money from the public will be given back to RBI. Why? Because they are purchasing a security, right? So in this way, money is reduced with the public. Okay, in an economy, if there is a shortage of money, okay, at that time, what will the RBI do? The RBI will purchase back the security, right? So in this way, the money supply, that is the liquidity, is controlled by the RBI through open market operation. Okay. So open market operation means it is the direct selling of bonds to the public, and it is used to control the money supply. How is it happening? By selling the bond, money is contracted, right? By getting back the bond, the money is supplied back to the economy again. Okay. Now coming to the next instrument, market stabilization scheme. So what is this market stabilization scheme? See, these are the special bonds on the behalf of government by RBI. So what is this MSS, market stabilization scheme? It is a bond, okay, by the RBI on the behalf of government. So we understood that this is a bond. But what is the use of it? Again, to absorb the excess liquidity in the system. Okay. So when the government sells this bond, okay, when the RBI sells this bond, what will happen? People will buy it if it is an attractive interest rate, right? So in this way, the money with the public will be controlled, right? So special bonds on the behalf of the government by RBI for specific purpose to absorb the excess liquidity in the system when regular government bonds prove inadequate. Okay, when the regular government bonds, that is repo rate, reverse repo rate, bank rate, all these, when the regular government bonds prove inadequate, okay, this market stabilization scheme will be used. Now, you have to understand that this market stabilization scheme is for a short tenure. Okay, it is for a short tenure. Probably it may be for 6 months. Okay. See, I have been telling you these are the instruments which are used by RBI to control the inflation. And I have told you the definitions as well. But in real life, in practical, how is this policies used to control the inflation? Okay. See, I told you inflation is the price rise, right? See, the price rise may be of different reasons, okay? That we will see in detail when we are into inflation. But now, let us assume that the price rise is because of money supply, right? So, because of more money supply with the public, there is a price rise, okay? How is it possible? Say for example, a person was having initially 100 rupees, okay? So for 100 rupees, he would buy only, let us assume, one shirt, okay? Now, if he is earning more or if more money is in hand, what will happen? He may have 300 rupees, okay? What will he do? He will again go for 2 more shirts, okay? But you should understand that when money supply is more, what happens? He is buying 2 more shirts, right? In that case, there is a demand for what? Demand for shirts, okay? Because there will be some other persons who wanted to buy for it basic necessity, right? In that case, what will happen? If this person is going and buying there, this person will be affected. How is this person going to affect her? That is the poor one who can buy only one shirt for the basic necessity. So see, how is this going to affect the poor people? Let us assume that there are only 3 shirts in the market. Okay, 3 shirts in the market. Okay, one person is there. His income, that is money supply, has been increased. Okay, there are 2 other persons. Okay, now what will happen? This person also will go to the market. Okay, both the people, these 2 people also will go to the market. Okay, in that case, see, what will the shop owner do? He wants to earn the profit, right? So what will he do? Seeing the demand, this person is asking 3 shirts. This person is asking, no, each of them are asking 2 shirts. But the available shirts are how much? It's only 3. So at that time, what will the shop owner do? He will increase the price to, say, for example, 120, 120, 120. Okay? He will increase it. What this person can do? This person, that is the rich person, being having 300 rupees in hand, what will he do? He will go to the market and he will buy the 2 more shirts, right? But whereas the poor section having only less money cannot buy it because he is having only 100 rupees with him, right? He will not be able to buy it. See, he is buying it for basic necessity. The poor people is buying them for basic necessity of clothing. Whereas the person whose money supply has been increased is buying it for consumerism. In the sense, he is having money in the hand, so he is consuming it, right? So what has the government do? What the good government has to do? See, the government should not look at the scenario and be quiet, right? It is not the good government's, attitude if it is keeping quiet. So the government will intervene, okay, and it has to reduce the prices. In this case, the government's work is done by RBI. Okay, so RBI has been designated completely to control the inflation. And that is what we have seen it as monetary policy instruments. So how these instruments are going to affect in the real life? Let us see now. See, what will the RBI do? I told this work, the inflation targeting, is done by RBI with the help of monetary policy. Okay. So what will the RBI do? See, RBI will increase the interest rates. Okay. Let us now take an example of repo rate. Okay. Let us take an example of repo rate. See, in the case of repo rate, what is it? It is the money which the bank borrows from RBI. Right. See, let us take a person, okay, who is going to bank and asking for loan. Okay, asking for loan, and bank is not having sufficient amount of cash. Okay, so generally what will the banks do? It will go to RBI. Okay, it will go to RBI and it will ask money from RBI. Okay, so let us say the person is asking 100 rupees and bank is going to RBI and asking for 100 rupees. During normal situation, okay, during normal situation, what will the RBI do? Let us assume that there is a 10% of interest rate. So, it means what? 100 rupees is given at 10% interest rate. Okay. Now, this bank cannot give the 100 rupees to the same money, same interest rate. Okay. So, what will these banks do? these banks will increase the rate of interest rate. See, let us take it is increasing to 13%. What is meant by 13% in terms of 100 rupees? It is 87 rupees. Okay. Now, what will this borrower think? See, the borrower might would have thought that, okay, for 100 rupees, let us assume that there is a 5% interest rate. It would be beneficial for him. So, he will get 95 rupees. Okay. So, he can invest in something, or he may have money supply in the hand, right? So, the borrower will think like that. But, if the interest rate here it is increased, what will the borrower think? Oh no, the interest rate is higher, right? So, if the interest rate is higher, only the real borrower who is in need of money will borrow it. Why am I using the real borrower? Say for example, see, in families, most of the families, everyone will have a vehicle. Let us assume that person A, person B, both of them are belonging to the same family. For a family, there may be one vehicle. Let us assume a four-wheeler. Okay. And if the same family thinks that person A is having a vehicle and the family thinks that we need to buy a vehicle for person B as well. Now, he will go to the bank, right? He will go to the bank. He will ask for the loan. So, the bank says that the interest rate is this much. Okay. So, what will this person think? Actually, he may not need it now, right? But for sake of having it, he would have come and asked for the loan, right? So, now this person will think whether it is necessary to take the loan, whether it is necessary to buy a product, right? He will think for a while before borrowing the money. But if a business person, if he really wants it to expand his business, he may not think about the interest rate, right? What will he do? He will get the money for that interest rate because it is really needed by that person. So, this repo rate, okay, controls the money supply with the public by increasing its rate. It means when repo rate is increased, the rate at which the borrower buys the money is increased. The rate is increased. So, only true players will borrow the money from bank. In that way, the money supply with the public will be reduced. Okay. Now, let us come to reverse repo. How is this reverse repo going to affect? See, I told you reverse repo means banks are going to deposit money in RBI. Okay, for a certain amount of interest. Okay, see, what will the RBI do whenever there is an inflation? The RBI will increase the reverse repo rate. Why? In what way it will help to reduce the money supply? See, here again and again I am saying inflation. It means we are talking about money supply. Okay. So, how is it going to help the RBI to reduce the money supply? See, if a person is going to a bank, okay, a person is going to a bank and RBI is there and a person is asking 100 rupees as a loan, and normally the bank would provide for, let us say, 5%. Okay. Now, RBI says, without giving the money to the customer, bank, if you're going to deposit with me, I am going to give you the interest rate of 12%. Okay. What will the banks do? Obviously, the bank's motive is what? It is profit, right? To earn profit will be the bank's motive. So, now what will the banks do? The banks will, instead of giving the money to the customer, it will park its money in RBI. So now what happens? The bank was having only 200 rupees and it was keeping 100 rupees, or let us assume 150 rupees with RBI. Okay. Now the bank will have only 50 rupees with it. Right? So when the customer goes to the bank and asks for a loan, the bank will not have money. Right? So the loans will be denied. When the loans are denied, the money circulation, that is, if this person would have got the money from the bank, what would have happened? That money would have come into the circulation in the economy, in the market, right? That is stopped. So this is how reverse repo rate is going to help RBI, right? Now, same way bank rate also. So see, bank rate also works like this. How? When a person is depositing money with the bank, what will happen? The bank will have 100 rupees. Now, another person is coming and asking for a loan. The bank would give 100 rupees and will have a bill, that is a document. Now, another person is coming and asking for a loan to the bank. Okay? What will the bank do? The bank will take this bill of exchange and will go to the RBI asking for keep this and give me some money. Generally, the RBI, let us say in a normal times for 100 rupees, it is rediscounting the bill at 10, okay, at 10 rupees, at 10%, okay. Now, during the inflation time, what will the RBI do? The RBI will say that I am going to increase the bank rate, that is, I am going to rediscount at 15%, okay, which means for what? For 15 rupees, that is, the bank will get only 85 rupees. So, it is a huge loss for bank. So, what the bank will do? The bank will not give the bill of exchange with RBI, and in turn, the bank will say no to the customer. So, this helps in what? This helps in controlling the money supply with public, right? So, this is how the money supply is reduced. So, assuming that for monetary policy purpose, inflation is because of more money with the public hands, this policy will help in reducing the money supply with public, right? See, the government and the RBI has to work together so that the inflation is not so high. But generally what happens? See, generally the government will try to increase the money supply in the public. How? By social security schemes, right? Or by spending in any kind of social schemes such a way that the money goes to poorer sections of the people. Why it has to do? Only then it can win in the next election, right? If it is going to cut short, say for example, the inflation is high. So, the government says that I am going to stop the 100 days MNREGA work to 70 days. Do you think that the next election will the same government come? No, it will not, right? But the RBI's sole and the main purpose is to control the money supply, right? So, always the ideas of the RBI and the government will be clashing with each other. But for an economy to be stable, RBI, that is any central government and any central bank, okay, have to work together so that without considering old bank politics, they have to work together so that the economy is stable, right? So, in this video, we have seen what is RBI, what is its structure, and the only main function we have seen, that is monetary policy. There are also some other functions of RBI, right? It is a banker to banker, lender of last resort, right? Like all these functions, we'll see it in the next video. Okay. See, today we have seen RBI to the maximum as a whole. Okay. I'll be covering the rest of the RBI and the banking system in the subsequent videos. After this RBI, I have a plan to start inflation and the external sector. So I would like each one of you who is watching these videos to recommend any topic which is missing or which you think which is really difficult to understand in the comment section, so that we'll take that in the next subsequent videos. Okay? Thank you.